Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. All right, earnings season has already started for 2023, and we got a lot of news out of the banks. But today, specifically, I want to talk about JP Morgan and what we can learn about what we think could happen in 2023, especially for the first quarter, and what all of this means. Now, today was probably one of the biggest earnings days of the year, or the beginning of the year for this particular quarter. So we heard from JP Morgan, we heard from Bank of America, and then we also heard from Wells Fargo. I'm going to center again on JP Morgan, and that is because, one, the stock was up 2% today, and their profitability jumped about 48%, primarily due to higher interest rates. Now, finally, we are right about the banks, because if you remember, if you've been around for long enough, at the end of 2021, we had talked about banks being one of the best places to invest in 2022, and that was because higher interest rates really help the banks. How do banks make the majority of their money? Not by overdraft fees, which are trash, but they do so because when they loan you money, whether it's a mortgage, student loans, credit cards, whatever, they make their profit primarily off of interest rates. If the Fed raises interest rates, banks have to raise interest rates. If they have to raise interest rates, they make more money. And that is what we are seeing from JP Morgan. JP Morgan is also quietly up close to 23% in the last 6 months. And I say quietly because, one, banks didn't perform the way I expected them to in 2022, but also JP Morgan, or rather investors of JP Morgan, actually rejected a bonus for its CEO, for their CEO rather, Jamie Dimon. He could have gotten $52 million, but the investors said no. You know, when you get those emails when you are investing in a company and they tell you to vote on stuff, yeah, enough people said no, and he missed out on a $52 million bonus at that point in time. Now, there were some ways he could recoup that. I'm not sure if he figured that out, but in either case, investors were upset because the stock had not been performing. But now, at least in the short term, it has. So, with all this stuff out the way, what do we know about 2023 and what can we glean from this? Because while earnings season is not a definitive, we can take this and we know everything we need to know, it does give us some previous information and gives us something to kind of go off of. It gives us some clues. So here's what we know. Right now, we already know, and we kind of knew this last year, but interest rates are going up. We know that that's going to help banks become more profitable. However, the threat of recession, which is really what drug down the banks in 2022, is still somewhat of a concern for the banks. If you're reading from JP Morgan or Bank of America or even Wells Fargo or Citigroup, they're still kind of mixed, as am I, in terms of whether or not this is going to be no recession, a hard recession, somewhere in between, and it's a little bit shaky. If you are looking to invest in the banks, I don't think it's a bad investment right now. I don't think it's bad. I don't think it's going to be as bad as 2022. I'll say that. But the thing here is, if we go into a recession, people aren't going to pay back those loans. That is going to hurt the banks. That's kind of how this whole thing goes. And you know that if we go into a recession, people aren't paying those loans, those are going to have knock-on effects, meaning that the same person not paying their mortgage is probably not going to go travel on American Airlines or Delta, which means that that's less travelers and passengers, which means that an investment I have, Las Vegas Sands, or any resort or travel type company, is also not going to see that type of revenue. So you can see how the entire economy is obviously chained together and connected together. So you do want to pay attention to those things. Over the next few days or so, especially since we're going into a long weekend with MLK Day on Monday, the market is closed. The market is closed on Monday. In case you didn't know, don't even open your app. You're not going to do nothing on Monday anyway. But aside from all of that, unless you're doing crypto, you still want to do that, you can do that. But aside from all that, I'll kind of dig in and see if we can find even more lessons between comparing all 3 to 4 of those banks and see if we can pull from it. Obviously, today is when they all announced. I couldn't read all 80-page reports from 4 different companies in a single day with 2 kids. Can't do that. Okay, I'm going to take my time and go through that and see what we can really glean from these. But the main thing here is interest rates are helping the banks. That is going to be something that could continue to help those particular companies if you're looking to invest. But the threat of recession is still real and still very shaky. I don't know, and I never had a crystal ball to begin with, but those people are paid millions of dollars to try and know, and they don't know. They haven't come to a consensus decision and a confident decision on where that whole thing is going to go. Which brings me back to my whole premise here is to still play the middle. If you want to do banks and finance stocks, I'm okay with that. If you want me to do like a top 10 or a top 5, please let me know. That helps me help you, and we can just easily pull together a list of stocks that make sense, or ETFs that make sense, exchange traded funds that puts all the banks in one investment for you. We can do those and then see what may make sense there. But again, in terms of playing the middle, I'm sticking with Smuckers. I'm sticking with stuff like General Mills until I get a hard decision on where the market is going and what we think, what we have a better footing on. This is similar to what we saw in 2022, and then Russia and Ukraine happened. We kind of waited to see what we think was going to happen, and then once that pattern emerged, we had a better picture of what to invest in and what made more sense, which is why we talked so much about insurance last year. Or we talked so much about dividend stocks last year too. Those still work. I think dividend stocks in almost any environment still make sense. If you want to list on that, feel free to tell me in the comments and we can talk about that as well. So that is what we learned so far. And again, it's day 13 of 2023. So it is still extremely early. Also, be aware, and we'll probably talk about this a little bit next week, maybe even on Monday, that there are going to be a lot of events coming out. It's earnings season, and you're going to see a lot of news. The market can be volatile during these times. At the time I'm recording this, I think the market is kind of teetering between being positive or negative. We'll see what it ends up being at the end of the day. For you as an investor, stay calm. As always, that has not changed. Relax and continue to absorb information and start to make conclusions based on where you are in your investment journey and what you need to do. All right, let me know what you think about JP Morgan. Do you own any of these banks? I don't own any banks right now that I can think of. I sold Capital One a year and a half ago, I feel like. Let me know what you think about the finance industry. If you want to learn more detailed, deep dive breakdowns and ask questions that get deep, detailed answers, you want to make sure to join the members only. We are releasing another video within the next 24 hours to make up for the video. So we do exclusive videos every single week, and I did one earlier this week and want to do a second one for our members only, so you want to make sure that you check that out. We're going to talk a little bit about portfolio balancing and why it is so important to understand where your money is in your portfolio. It's one thing to own 10 stocks. It's another thing to have 90% of that money in one single stock, and that can really throw off your performance. So we'll talk a lot about that this week. All right, that is it for me. I'll talk to you later.